Good morning, friends. We are coming to you from the headquarters of Teeple Snyder Newsome Wealth Management here in Brownsburg, Indiana. I'm here with my friend and partner, Matt Snyder. I'm Matt Teeple. We're here for a little fireside chat, if you will.
Yeah.
So, how are you doing?
Good. We're excited for the next quarter and can't wait to dive in.
Well, and you don't know this, but third time's a charm. We are working our way up to be social media influencers. So take three. Talking about the economy. So it is very difficult to forecast things like stocks in the economy in the short term. It's much easier to do in the long term. There has been some notable changes in the last 3 months. So talk to me a little bit about macroeconomics. What positive changes maybe have we seen?
Yeah, positive changes. It's a little murky, as it always is. As soon as you get a good report, sometimes it gets amended a month later. But
Right.
So far, what we have seen is an uptick in a couple of things. So like the leading economic indicators are still forecasting negative growth, but they have improved
Right.
a little bit over the past few months, which is something that we do lean into quite heavily and have looked at the leading economic indicators for really the past decade as a good source of economic data. GDP has slowed, but has still been positive
Right.
so far, which is a good sign. And so a number of things that have slowed but appear to be starting to improve again. Once again, caveat here going into the next 2-3 quarters. I would say there's still a bit of a concern with cash in the economy and the consumer's ability to continue spending.
Right.
But overall, compared to, let's say, 6 months ago, there does seem to be a little bit of a pressure release in the economy.
Well, we're definitely not out of the woods, but the chances of recession maybe has reduced a little bit. You'd mentioned cash in the economy. I mean, we injected tons and tons of stimulus. I would argue that's one of the only reasons we haven't gone into recession up to this point. We've never seen $5 trillion of stimulus injected into the economy like it was in 2020. A lot of that has been used up, especially on the consumer side. I mean, you have talked a lot about that. How does that factor into this?
Well, if consumers run out of cash and consumers end up slowing down their spending, the only way for a business, a corporation, to generate revenue is if consumers buy their products, right? And so that's a concern.
Right.
It's not as though we are at abnormally low levels of cash. It's just that we're a lot lower now than we have been over the past 2-3 years, right after the COVID stimulus.
When we were flush with cash, savings rates were high. Savings rates at this point are low. We somewhat even, as consumer spending was slowing, government spending was ramping up. And that is something that we all know is not sustainable over the long term. But last year, government spending was 8% of the size of the economy. Well, the economy is $30 trillion. So we added $3 trillion of deficit spending that put more debt on top of our mountain. I would argue, especially in a high inflationary environment where we're trying to ease things down, hopefully not going into a recession, that probably was not a good use of our money. We seem to be doing everything at all cost to avoid recession. Is that a good thing long term?
Well, anytime you take a short-term benefit and inject cash that is realistically cash that is going to be generated over the long term and say, hey, we're going to allocate future revenue to spend it now, you're sacrificing the long term for the short term. You're robbing Peter to pay Paul, and that bill ultimately does come due at some point now, whether that's over the next 3, 6, 12 months or 3, 6, 10 years will be determined.
Right. I was looking at a report by the Congressional Budget Office. Congress doesn't play nicely together a lot of times, but they all seem to be on the same page as a nonpartisan Congressional Budget Office report. They all tend to agree that deficit spending is going to widen, not narrow. So our deficits are going to get larger and larger and larger as a percent of GDP. Part of that is because we have more debt, finance debt ever increasing interest rates. The other part is we have entitlement programs that are underfunded, and we're going to have less and less available for discretionary spending. And because of that, their projection for debt relative to the size of the economy is ascending a mountaintop. Where we sit today, our national debt is a little bit bigger than the size of our economy, so it's more than 100%. The only time that we have been this high was coming out of World War II, where we had to do what we had to do to win the war and save the world. And following that period of time, we did everything we could to bring debt back down to a responsible level. And over the last 15, 20 years, our debt has grown considerably, and the projection is that it will go considerably more. Now that, to your point, will have long-term economic detriments. What does that mean for public equity markets?
Yeah, public equity markets, following the economy is what we like to do, is because long-term, realistically, you would expect the pool of public stocks to track along with the broader economy. And so our concern at this point is that if we have robbed Peter to pay Paul, if we have sacrificed long-term growth for short-term benefit, the concern is that possibly over the next 5-10 years, it'll be very difficult to emulate the level of growth that we've experienced over the past 5-10 years.
Right. Yeah, I was just looking at a report from Charles Schwab that they put out showing historical returns from various asset classes and then what their forecast is for the coming decade. On U.S. large cap and small cap stocks, the magic number over the last 30 some years, and even beyond that, has been about 10% annualized rates of return. Mm-hmm. Their forecast for the next decade is only 6%, so a huge haircut from what's normal, based both on the structural issues that I'm talking about with our huge debt and deficits and whatnot, but also our starting point in valuation. Can you expand a little bit? Valuation's probably my biggest concern.
Valuation, we talked a lot about valuation at our last quarterly update here. And valuations haven't changed much over the past 3 months, except that they may have actually gotten a little bit more expensive. Stock markets continue to rise, which, looking strictly at valuation is probably not the best day trading strategy, but it does speak significantly to a long-term trend. And right now, the S&P 500, for example, is trading close to 21 times earnings right now, which historic norm is close to about 16 times earnings. So they are running very high. You've been in this business a little bit longer than I have. So tell me a little bit about where that stands relative to the past couple decades.
Yeah, it's the highest it's been since I've been a financial advisor, with the exception of coming out of COVID. When COVID happened and we shut down the economy, earnings of businesses plummeted, mm-hmm. and eventually we injected a bunch of stimulus and prices soared up very quickly. And because of that depressed earnings denominator and then quickly appreciating prices, there was a very small period of time where that ratio was more expensive than what it is today. It didn't last long. Absent that, these are the highest prices we've seen since coming out of the dot-com bubble. And if they continue to go up at the rate that they're going up, without earnings fundamentally driving those increases in stock prices, we are literally watching a bubble form before our very eyes. And the problem with bubbles, they're painful when they pop. They always do, and it's unpredictable on when that's going to happen.
And so valuation's a concern.
Valuation is
very
a
significant concern, but is it a concern across every asset class? What's an investor to do?
Yeah, so picking pockets of value is going to be more critical than ever. The idea of just doing a 60-40 or 50-50 balanced portfolio where you put 60% large cap stock, 40% bonds, that's likely a broken model at this point, because if stocks are only going to do 6% and bonds might do 4 or 5, trying to shoot for 8% rates of return on a blended portfolio, it's just not going to happen. So finding pockets of value right now, mid-cap stocks substantially cheaper than large cap stocks, small cap stocks the same way, even international stocks. If you look globally, the last decade has been outperformance U.S. versus international. That has not always been the case, and I think we could be at a tipping point where international stocks outperform because of their starting point and better structural fiscal policy and whatnot where they're at.
Yeah, so the starting point is critical, and if their valuation, price to earnings valuations for those stocks are at a lower point than the U.S. market, then there's just
Right.
a little bit more wiggle room to
Yeah.
come back to the mean. And so right now we are taking a little bit more of a tactical approach
Right.
and saying, hey, let's at least stay diversified. We're not saying don't invest
Right.
in large cap stocks. You know, those have been historically great investments, but it probably makes sense to start taking some of the gains in that asset class that we've
absolutely.
experienced and maybe leaning into these other assets. Is
Yeah.
there any other options that we're pursuing right now?
Oh, yeah, absolutely. So private equity, I think, is going to become a more and more and more important feature. What is private equity?
Yeah.
You've been leading the charge on helping expand our options with that.
I'm really excited about private equity. Like you said, I've been digging my fingers deeply into this research, and private equity has been one of the longest investments in time, really. I mean, private equity is basically just any business that's not public, from the mom and pop shop down the road to some of these very, very large, like Grubhub, for example. Grubhub is still technically private,
Okay.
and so might be going through an IPO, but it's basically a company that hasn't gone through an IPO yet to where it's publicly available to everyone, and that's been the hard point. This has been the pain point, is that it's not publicly available to everyone.
Yeah. Well,
So-
and if you think about it, small business has been the lifeblood, even the majority of the size of our economy. The public equities are actually in the minority, but investment in private equity has been limited to endowments and major institutional investors because investment minimums have been so huge and lockup periods have been long. That's
Yeah.
finally changing in a dramatic way.
It is, and I'm excited because as it changes, it means there's more opportunity for investors like ourselves and our clients to
Yes.
be able to participate in some of these private equity investments that no longer require you to put up, $500,000 into a single company. Now you can make a much smaller investment and have a diversified portfolio of private equity that, quite frankly, private companies just run at very different valuations
Right.
than public markets. You get a lot more bang for your buck, so to speak.
Oh,
So talk
absolutely.
a little bit about that.
Yeah, well, a lot of our listeners and clients are Dave Ramsey enthusiasts. Dave Ramsey talks to small business owners a lot, and in the legacy planning piece where he's talking to people about transitioning their business to another family member or maybe selling and retiring, he talks about how do you value your small business. And his general rule of thumb is your small business is probably worth about 4 to 5 times net profit. Well, that is a price to earnings ratio, is the price of your company relative to the earnings or net profit of your company. And at 4 to 5 times net profit, which is what his rule of thumb is, compared to 21 times, I mean, we're talking 4 to 5 times cheaper than
Yeah.
public markets, which is exactly where finding pockets of value is going to be critical. And private equity is a huge opportunity. I mean, endowments have been doing this for years and years and years. This is not a new asset class. It's just
Yeah.
newly available to retail investors at shorter lockup times and much lower investment.
So I'd be curious. You say endowment funds have been tapping into these. Like, to what degree? I mean, in our model portfolio for a lot of clients, and what clients are very much used to, they're used to, like you said, the 60-40 portfolio.
Yeah.
60% in public stocks, 40% in something else,
Right.
like fixed income, something more conservative. How are these endowment funds structured?
Well, it's funny. I just looked up the Harvard Endowment's annual report because I was curious about that very topic. I knew that they do a lot more in alternatives and private equity, things like that. I was curious to what extent. So I looked it up. In their annual report, they have 39% private equity allocation.
Wow.
Other alternatives beyond private equity bring them up to over 80% alternative. And if we compare apples to apples on that 60 to 40 balanced portfolio, Harvard has 11% public equity and 6% public bonds. 80% of what they're doing is what we're talking about.
Okay.
And these are the smartest people in the world. They know that they can get better returns for lower volatility, and that's why they're doing it.
Yeah, well, you say lower volatility. I mean, from a risk perspective, what kind of risks are we talking about here?
Well, public equities, I mean, equity is equity, right? It's ownership in a business. The only thing that makes these different is public equities trade on a public market. So investors can whipsaw the price all over the place based on, if the president burps, you know what I mean? Any fear or greed that they can overreact to, they will. And so volatility in public markets is much more dramatic than private markets. I would even point out, people get concerned and they think, small businesses are risky. They're really not necessarily. What makes a business risky is when it's poorly run. If you take on too much debt or focus too hard on the short term versus the long term, that's what makes a business risky. And more companies are choosing to stay private rather than go public, because as soon as you go public, you're responsible to those crazy shareholders that are fearful and greedy, and they want every quarter to be perfect. Well, and you try to make the short term perfect, just like what we're doing as a nation with trying to avoid this recession at the expense of the long term, you can do more harm than good. So personally, I like the fact that there's lower volatility and it's not publicly traded. And, if I only have to lock up my money for 3 months at a time, that to me is a small price to pay for enhanced returns and much lower volatility.
Yeah, and that's kind of the structure that we're seeing in a lot of these new private equity investments, is that they might have lockup periods of 3 months or 6 months, as opposed to 7-10 years.
Right.
That you used to have to lock up your money for. And so we're pretty excited.
Yeah.
Looking to do some more due diligence in this area and have some conversations. If you have questions on this, certainly feel free to reach out, and we look forward to hearing from you.
Yeah, if you've liked and learned from this video, feel free to like it or subscribe. We'll continue to do this on a quarterly basis and give you the same insights we're giving to our clients. So thank you very much for joining us.